Everybody has been hearing about, that we today exist in a world of man versus machine. And I think at PL and at the asset management vertical, we truly believe that in a world of man versus machine, the best approach to take is a man with machine approach.
So let me have the privilege of introducing Siddharth. Siddharth is a chartered accountant and a CFA chartered holder. He's also completed his MSc in management for business excellence with a double diploma in world politics from University of Warwick. That apart, Siddharth has successfully completed summer program from world-renowned universities such as Harvard, London Business School, London School of Economics, and Cornell. Siddharth is the youngest fund manager that we have in the country, perhaps. He joined the group Prabhudas Leeladhar in the year of 2016, led various initiatives like investment advisory, the multi-asset portfolio. He conceptualized the multi-asset portfolio under the PMS platform. They were the first one, early one to think in those lines. And then apart from that, side by side, Siddharth was also working on developing the quantitative strategy. And then they launched their Prabhudas Leeladhar Aqua fund, which works on quant models. So today the whole idea of inviting him is to understand how does it work. So thank you so much, Siddharth, for accepting a request and taking the time out. Really appreciate to join this call.
Thank you so much, Vikas. I've always liked interacting with you. Even in the previous session, I think we had a really good conversation going, and so many of your investors have also been a part of the Aqua Fund, and they've experienced really good performance in the last 1 year. So.
Yes, absolutely. So, yesterday, Siddharth, there were two panelists, Mr. Pratik Agrawal from Motilal and Shankar Sharma. And there was a discussion that how quant investing is shaping up. And both of them were very bullish about the whole thing. So, congratulations that you are the early one to think in those lines and start. So, maybe if you can give us more insight about how do you do it for the benefit of our investors. If you
Sure,
wish to
sure.
run any presentation, all yours. Over to you. We have
Yes.
time. 12 o'clock.
Oh,
Yeah.
okay, perfect. I've already shared my screen. Is it visible?
Yes, very much.
Okay, perfect. One second. Okay, great. So, hello everyone. Thank you so much, for taking our time and joining us today. Today, we're going to talk about the Aqua Fund or the Aqua PMS strategy, which we operate at the Prabhudas Leeladhar Asset Management vertical. And this is one of India's pioneering style agnostic and style adaptive quant strategy. And what we actually bring to the table is not a strategy that we just call quant for namesake. It's actually a pure, true blue quant fund where all the investment decisions are taken by our quantitative models and quantitative frameworks rather than having any layer of human intervention whatsoever. And I think lot of credit to all the work done by our team in the last 5 years in developing this strategy, in developing all the models, and sticking to the discipline of following quantitative models with lot of rigor. So what we've been able to do as a team is over the last 1 year, we've generated close to 75% plus absolute returns for investors, which is almost 35 to 37% alpha over and above the benchmark, which is BSE 500. How we've been able to get this performance is very critical in understanding not just how Aqua delivers performance, but the future of quant funds in India as well. So I'm going to quickly take you guys through the key contours of the strategy, how quant is shaping up in India, why is quant such a relevant approach in today's day and age. We're going to talk about multiple topics as such. And Vikas, please, feel free to ask questions, interrupt whenever you find the need to. So everybody has been hearing about, that we today exist in a world of man versus machine. And I think at PL And at the asset management vertical, we truly believe that in a world of man versus machine, the best approach to take is a man with machine approach, because the human actually brings a lot of intelligence, a lot of wisdom, a lot of understanding of capital markets, which is then programmed and taught to the machine. But the machine brings a lot of rigor, a lot of discipline, a lot of data analytics capabilities, which the man alone would miss out on. So instead of choosing one over the other, we believe that the best way to invest in today's world is actually leverage the strengths of both the human intelligence and the machine computational power. So what we really do is all of us spend time on designing and defining the investment strategy, the investment processes, and the investment models, which then throws the output in terms of which stocks to buy, what sectors to be allocated in, which investment style to use in which market cycle, what should be the mix of large, mid, and small caps, how much should be my portfolio beta at a certain point in the market cycle. All of these decisions are taken by the machine, but the rules to make these decisions are actually programmed and taught to the machine by the team of human analysts and quants in our team. We now have a team of 20 quants, and we started this journey close to 5 years back when we decided that quant is the future in investing. 5 years back, it wasn't as relevant and as talked about as it is today. And we do have an early mover advantage because we've put in 5 years of work when many people on the street didn't really pursue quant. The biggest advantage of quant is it helps you rise over and above all the traditional investing biases, the behavioral biases that we face on a day to day basis. So, we have a very firm belief that in long term investing, what you really need to do is rise above your emotions, is rise above all the past experiences that you probably had, which are governing you to hold on a stock when you're not supposed to, fall in love with your stock when you're not supposed to, exit a stock when you're not supposed to, buy a stock at the wrong price. There are so many things you can do to get it wrong. But when we take a machine driven approach, a rules based approach, an objective approach, some of the big advantages that we get is we have absolute transparency. We know why which stock is entering our portfolio, why is a stock exiting our portfolio. And I think having a well defined exit strategy is clearly one of the biggest strengths of quantitative investing. Active investing usually does not give you a very, very objective exit strategy, but with quant, you really get that. And I think globally also, quant is managing a lion's share of money, close to 35-40%. And the reason for that is two: superior performance and better risk management. I think our models, which process, macro data, fundamental data, technical data, sentiment data, valuation data, liquidity data, monetary cycle data, risk analytics data, all of this data together, which is processed, helps us in responsibly managing risk rather than trying to predict risk, which is anyways unknown. The biggest sources of risk are the ones that are not known. If it is known, you already know how to deal with it. So we believe very firmly that in managing money sustainably for alpha generation, what we really need to focus on is being responsive to the market data, to the market cycle. And therefore, quant gives us a lot of edge in that. And couple of critical things that investors must know, that today in India probably quant is nascent, it's new, it's early, but of course it's getting a lot of money from investors who've recognized its sophistication, who've recognized its merit. In America, for example, I've just populated some data. What we are showing here is 89% of all the money was managed actively in 1989, as opposed to 11%, which was managed passively. Come 2023, that 89% active share is down to 26%. 39% is now managed passively. And quant, which didn't exist at all in 1989, is now managing 35% of its assets. So clearly, quant has taken a big lead over active as well. And in India, the number is close to 1.5% as of today. So obviously, over the next decade, as more and more investors realize the sophistication that is available now in investing, people will move to quant. And there are a couple of simple reasons, right? First is, of course, outperformance. Here I've just populated a data that in 5 years in India also, 100% of all the quantitatively managed schemes have actually beaten the benchmark, as opposed to just 47% of actively managed schemes. So that is reason number one why quant strategies will grow popular. The other reason is everyone in every sector today is talking about AI, ML, using technology, using machines to improve efficiency, to improve processes, to improve decision making. If your TVs, your mobile phones, your cars, your homes, if all of these can get smart, why shouldn't an investment strategy become smarter? So the whole reason is, in say 50 years back, we probably in India used to wash clothes with our hands. But over time, we obviously use washing machines. Similarly, we had pen and paper calculations being used, say, 75 years back, which then moved to calculator, which then moved to Excel and Tally, and now it's at Python and ChatGPT and AI. So obviously, there is an evolution and an upgrade. So we believe that even in the world of investing, people will eventually choose to upgrade to quant, given it's the more sophisticated way of managing money. And obviously, there has been a massive growth in India as well. The base is very low, but the growth has been massive. Almost 271 crores in 2013, close to 70,000 crores as of 2024. So it's been a multifold growth, unlike growth seen in any other field in the asset management industry. So what PL really brings on the table for all the investors is, we've been pretty much the pioneers in the quantitative asset management space in India. So we've got pretty 5.5 years of R&D track record and 2.5, 3 years of fund performance track record for the first strategy, which was a multi-asset strategy. Now the second strategy, which is Aqua, that is obviously now completed a year as we stand. And so we've got a pedigree, obviously, of traditional research, but with that, we've used our proprietary quantitative capabilities to develop a complete niche within the asset management industry and pivot to quant. Quant obviously involves building comprehensive infrastructure, data pipeline, and proprietary technology, which is the pillar of all your quant strategies. So over 5.5 years, we've been able to diligently and rigorously build that for our investors. The biggest advantage of quant is that it relies on processes to drive performance rather than any key man or key fund manager to drive that performance. And given that it is driven by processes, it is more sustainable. Finally, we have a very seasoned and experienced investment committee comprising of Dr. Punita Kumar Sinha, Mrs. Amisha Vora, and a lot of other senior members from the industry. And PL has obviously been around for the last 80 years in the capital market space. So obviously that brings a lot of, research expertise, capital market understanding, and investing wisdom to the table, which we have used in our quant models. And finally, we run with a team of 20 to 22 quantitative specialists who are professionals from the different fields. They all understand computer science, computer programming, and they also understand financial domain knowledge, like a CFA or a CMT or an FRM, or statisticians or mathematicians. So all our team members actually blend the best of both worlds, understanding of technology and computer science, and understanding of financial research as well. And that is what makes the quant team very different and special from a traditional team. Finally, we now understand what we are trying to do with Aqua. So let me just give you guys a quick introduction on what Aqua is focusing on about. Aqua is actually focusing on the principle of adaptability. Adaptability means the ability to shift gears based on the market conditions. So the way we divide the market in 3 broad phases. First is the risk on phase. The second is the risk transition phase. And the third is the risk off phase. So in the risk on phase, what we're trying to do is focus on generating returns, focus on generating positive upside alpha, These are market and macro conditions where the economy is robust, the liquidity conditions are favorable, the outlook for liquidity and monetary cycle is favorable. The focused asset class in a cycle like this is always going to be equity. We would have a mid and small cap tilt in a risk on phase, and we would be focusing on cyclical and emerging sectors. We would be open to take slightly higher market risk or a higher beta exposure in a cycle like this. This is the phase which we experienced in Aqua from say June 23 when we started the fund till December 23. This was the phase where 75% of our portfolio was mid and small. Post that, we've been in a risk transition phase. A risk transition phase basically shifts focus purely from generating returns and capturing capital growth to looking at risk adjusted returns. When we look at risk adjusted returns, obviously our focus asset class is still equity, but within equity, our allocations will shift minorly from small and mid to large and mid. This is what helps make the portfolio a little more defensive in a phase like that. Even in the defensive phase, obviously your stock selection will aid in generating upside alpha. And now we will be aiming to reduce portfolio beta. So probably till December, we were operating at a beta of 1.6. Post December, we've been gradually reducing beta from 1.6 levels to 1.3 levels. So while the beta is still high, you're reducing it to manage risk and look at risk adjusted returns. Finally, when you enter a risk off phase, that these are times when there's uncertainty in growth. You want to create some cash if there is a systematic global asset class risk. At the same time, you want to shift focus to large cap. The style focus in a cycle like this will move to quality, low volatility dividend, and you will add more structural and secular defensive sectors in your portfolio. In a cycle like this, your portfolio beta will be significantly lower. This phase is usually enabling investors or enabling our strategy to look at more macros and fundamentals rather than sentiment and technicals. So it's very critical to see that in a risk on phase, technicals and sentiment and liquidity drive the markets. In a risk transition phase, fundamentals and valuations drive the market. And in a risk off phase, macros, fundamentals and volatility drive the market. So it's very important to understand what is driving the market in which phase of the market cycle, and accordingly adjust and adapt your portfolio to that. Given that we've understood that one style of investing doesn't work well across market cycles, we need a style of investing that is actually fluid, that is actually unconstrained and adaptable to the market cycle. So the way we look at it is, when we are in a good market cycle, we focus on a growth and momentum style of investing. When our risk paradigm is shifting, we tend to look at value as a critical factor of investing. And when we move to a low risk zone, we look at quality and low vol as the preferred style of investing. Now, why this is a very, very critical point, right? Actively, or as a human fund manager, it would be very, very hard for me to actually change my investing style based on the market cycle I'm operating in. If I'm a value fund manager, I will stick to my value style irrespective of the market cycle. If I'm a growth focused investor, I will stick to a growth style of investing irrespective of market cycles. Similarly, if I'm a quality focused investor, I will stick to my quality style of investing across cycles. But data suggests that this actually doesn't work across cycles. So I'll give you guys a quick glimpse of how these different styles operate and how we need to be adaptive to actually make alpha across cycles. So this is just a quick plot. What I've done is ranked the different investment styles by their performance every year. So the higher the rank, the better the performance. So this is not saying that rank 1 is the best. This is saying rank 14 is the best because it's at the top of the ranking table. So let us look at, say, a quality to start with. Everybody talks about quality as a very legitimate style of investing. While we do agree that, quality as a factor adds a lot of value to your portfolio, we strictly believe two things. 1, quality cannot be looked in isolation. 2, quality cannot be your preferred investment style across market cycles. So it needs to be used in a multi-factor approach. It has to be one of the factors we consider. Similarly, it has to be a factor that we consider more importantly in some cycles and a little less importance to be given in a certain other cycles. So what we're trying to show here is every year the rank of quality shifts very, very dramatically from the best performing style to the median style to the worst performing style, again to the best performing style, median style, worst performing style. Even if you look at small and mid cap, they move from best to worst very, very drastically. Even if you look at value as a style of investing, it moves from best to worst very, very drastically. Even momentum as a style of investing goes from best to worst extremely sharply. So none of these styles are good to be used alone. So what I've shown as the first chart is, if you combine these factors, use a multi-factor approach, you are getting a chart which is much more stable. You're not getting a strategy that is best performing in a certain year, worst performing in another year, again best performing in a third year. We are getting a much more stable chart, which is clearly showing that a multi-factor approach that or a dynamic multi-factor approach that Aqua is using basically stands in a top quartile or a top rankings across market cycles. And this enforces two clear things. First, be agnostic to any one investment style. Second, be adaptive to the prevailing investment style. So with that, the core pillar of Aqua is set in place, which is that we are not only India's pioneering style agnostic strategy, we are also a style adaptive strategy. And this itself is the inspiration from the nature of water. The way water can take, any shape, any size, even with Aqua, we have designed a strategy that can change its color based on the market cycle. We focus on changing the portfolio across 6 key dimensions, which is its asset mix, its market cap mix, its sector mix, its investment style mix, its beta mix, and therefore its security mix. Important to understand that this portfolio is rebalanced every 2 months. It's a portfolio of 25 to 30 stocks, completely benchmark agnostic, sector agnostic, and style agnostic. And the beauty of the portfolio is that we use an equal weighted approach to construct the portfolio. Why is an equal weighted approach very, very critical? First, it eliminates any allocation bias. Second, it ensures that your returns are granular, they are repeatable, they are well diversified across stocks and sectors. And that is what makes your strategy sustainable in nature. If I was using very, very high allocations to some of the top performing ideas or some of my high conviction ideas, that would make my portfolio skewed to the performance of the top allocations, which is not sustainable across market cycles. With an equal weighted approach, your portfolio is divided across 25 to 30 stocks with an equal weight. Therefore, your risk is also divided across 25 to 30 stocks with an equal weight. And because this is process driven, you tend to get much more consistent performance. We've obviously tested Aqua since 2006 across market cycles. And this is the conviction and edge that we get using a quantitative approach. The ability to having tested your strategy for, say, the last 17, 18 years, having seen a lot of bull and bear cycles, gives you the confidence that the strategy we've designed will stand the test of time. Couple of other critical parts here is this strategy does not have a holding period bias. So neither are we focused on buying and holding for 5 years, nor are we saying we want to buy and hold for just, say, a month or two. Neither does this strategy have any fund manager bias. So fund managers also bring a lot of risks and bias. Firstly is the style bias. Secondly is the group and type of company bias, which means I won't invest in PSU, I won't invest in real estate, I won't invest in infra, etc. With Aqua, we've obviously designed a strategy to rise above all that. We are open to investing in PSUs, in real estate, in infrastructure, in capital goods, in engineering, across the sector. And finally, we don't have any benchmark bias. This is a non-benchmark hugging portfolio. Vikas, sorry, you want to say something?
No. So I was saying that to continue, we have next few minutes, and there are other guests who join.
Sure. I'll wrap it up in 5 minutes or so. Yeah.
Sure.
So the investment framework behind Aqua focuses on the 6S principle. So what 6S really does is we try to look at the portfolio in two different dimensions. The first dimension is the top-down dimension. Here we're trying to answer three critical questions. First is, what is the investment style that I should use in the current cycle? Which are the sectors I should be overweight, underweight, and zero weight? And how much risk I can take in a given market cycle? So my top-down layer answers these three questions. My bottom-up layer looks at how to select stocks given the current style that we've chosen, given the current sectors that we've chosen, and given the amount of risk we've chosen. But the stock selection looks at three key factors: the holy trinity of fundamentals, valuations, and technicals. So we need to identify stocks where there is a superior fundamental or a relative change which is improving over the last, say, couple of years, where the company is showing improved performance versus its peers and versus the broader markets. We want to capture companies which are showing solid improvements in fundamentals. We also want to ensure that these companies have relatively cheaper valuations than their past, than their peers, than the broader markets. And finally, this should also reflect in the technical strength. So once we get a combination of these three, those kind of stocks come into our portfolio. So over the last 12 months, our portfolio has focused mainly on industrials, automobiles, diversified financials, a bit of exposure to real estate, and these have been the four, and energy and utilities. These have been the five key sectors that the portfolio has been focused on. And if I look at my returns since inception, we are standing at close to 78% returns in the last 1 year. That is an outperformance of 41% versus the BSE. And if I look at how the portfolio is done month-wise, one second, let me just pull up that slide. Yes. So we've had 12 months so far. Out of the 12 months, there have been 2 months where we've underperformed the benchmark and on an absolute basis. All the other 10 months, we've actually been outperforming the benchmark or delivered positive returns for investors. So that's a very, very strong strike rate. When I look at the 6 rebalances that have gone through, 5 out of 6 we've outperformed or delivered positive returns. And only 1 is a rebalance where we've delivered negative returns or underperformed. And if I look at the quarterly trajectory, all the 4 quarters we've delivered absolute positive and benchmark beating returns. So the important point of this 70%, 75% plus returns is that it is consistent, it is well spread out, it is granular across time periods. And we've worked with a hit ratio of 64%, which means 64% of all the stocks held in Aqua's portfolio across time periods have actually beaten the benchmark. So the returns are not concentrated in a few ideas. They've actually come in from a majority of stocks that have been held in the portfolio. And finally, these are some of the big winners that we've had in the portfolio. Names like Cochin Shipyard, BSE, IRCON, NBCC, M&M, Hindustan Aeronautics, Apar Industries, Adani Power, IOC. This is just a glimpse to show you what kind of stocks we've held in the portfolio. Tata Motors, Motilal Oswal, etc. And given that we don't have too much time, I will quickly, open the floor for any questions that you guys might be having.
No, so with that, we'd like to conclude the session here. We have a separate session for Q&A.
Okay.
So we'll be discussing on those things out there. So thank you so much, Siddharth, for a lovely presentation. Got a lot of insights. Future is quant investing. We already discussed about it. So wish you all the very best and congratulations.